Welcome to Market Masters. Of course, we have to have a Market Master because the Nifty regained its all-time high earlier this week and is shooting to new highs as we speak. Now, this feat is hardly surprising, what with the Indian economy chugging along as the fastest-growing economy in the world, fastest-growing large economy. Yet the new highs are coming at a time when the Fed, the ECB and the Bank of England look determined to slow down their respective economies. So should one be wary of the Nifty climbing at a fast clip from here on? Are there dangers of a sharp fall later this year as a result of the global rate hikes? Can Indian equities rally or at least outperform even if the world slows? What are the best sectors and stocks to bet on here on? I have with me undoubtedly a market master, Manish Chokani, Director, Enam Holdings. Well, that is a very small description of a person who knows so much about markets. Manish, good morning and thank you very much indeed for joining us even as the Nifty is hitting new highs. But let me zoom out and ask you to parse the global economy for us. We saw the US GDP data getting upgraded, which means there could be even more pressing of the brakes by the global central banks. So does the latter part of 23 look challenging?
Thanks for having me. You've given a very tough job to me with the amount of stuff you've laid out there. I'll do my best to try and put some things together. So taking the first question head on, I think the context for all investors is to understand that there is really a change of leadership going on in the world, where the developed world has become old because of demographics, and they've become highly indebted because of the amount of debt that they've put onto themselves. And with the enormous amount of money printing which has been going on since 2008, and then just accelerated in this COVID crisis by just printing more and more. And that is showing up as something which is leading to inflation, because in real terms, their consumption basket hasn't gone up. So they've taken world GDP from, say, a $80 trillion GDP to in excess of $100 trillion GDP. But all you're doing is you're paying 25-30% more for the cars you buy or for the Starbucks coffee you have or the hotel rooms you pay. Actually, it's a lot more than that. And that inflation isn't going away in a hurry. And on the other hand, you have India, which is coming off a low base where the profit expansion is still starting out. And we went from a low of 2.5-3% of GDP to 4.5% of GDP as a profit number. But remember, we peaked at 7.5% in the first decade of this century. So we have a lot of headroom to run.
From 1990 to 2007, China had that demographic bulge, the demographic dividend. And you know the wall of money they got, both FPI and FDI, FDI mostly. Now we are at the cusp of that demographic bulge, in fact, already there. So can you elaborate more on this wall of money? Are we going to see it both in FDI, FPI, and even, those GCCs, the middle office moving to India?
So if you think of it, there are a lot of global trends which are actually playing into our favor, and we've done a lot of preparatory work for that. So let me first lay the scene in India for you, that if India hadn't done all the work that we've done in, for example, cleaning up our banking system, the insolvency bankruptcy code where assets can turn, putting in GST and creating a common market, putting in RERA, which allows real estate to actually, then be traded with a lot more trust in the system. Also the build out of infrastructure, which the government's, of course, focused on roads and rails and logistics to get them moving. And the private sector has played its own hand in terms of building out the telecom infrastructure, the ports and the airports and so on. Power and all of that is actually in place for almost like a manufacturing renaissance in India. Now, juxtapose that with the fact that Germany is no longer getting cheap fuel from Russia, and that used to be the manufacturing powerhouse of Europe. And similarly, USA had pretty much outsourced its manufacturing to China. Now, it's been a wake-up call for both US and Europe that we need to have a lot more resilience in our supply chain and less over-dependence on one or two not-so-friendly economies. And in that vein, you saw what happened with Prime Minister Modi also when he went to US, that they're going out of their way to woo India and bring them into the fold, where we become a reliable supply chain partner. So now the advent of, say, an Apple into India creates a whole new ecosystem for electronic manufacturing, the whole EMS segment, which is taking off, the work that Tatas are doing with them and building up almost like a new Foxconn in India. It unleashes what would have happened, say, 30, 40 years ago when Maruti came to India. or when GE came to India for the software services side. So it's a whole industry building out over there. And we're getting embedded into these global supply chains. And you have the skilled young manpower, which the world lacks. What's happened is after COVID, this work from home, people not wanting to work, they've got wealthy, they're just not showing up to work. You can't outsource it to China. Where do you go on scale? So while we were the back office to the world for IT, it's increasingly become the back office of the world even for other services. So, whether it's all the big five accounting firms or the management consulting, everyone is running their back offices on the services side in India. And I suspect this is slated to happen also on the manufacturing side. And we have done all the right things on a preparatory side with all the supply side reform in India to encourage all these players from overseas to come into India. So I think this trend accelerates. You will find a lot of money coming on FDI side. Private equity is sitting with a wall of money also waiting to be invested here.
Yeah.
And of course, like I said, on the FPI side, I don't think there's a single investment committee in the world which is not actively looking to see how they can up their exposure to India.
Yeah.
So it's a market which, like I said, each time there's a dip, there are 10 people waiting out, and each time the market gets slightly overpriced as we were 18 months ago. There's maybe 5 or 10% of the money or the chips are taken off the table, but they're finding the re-entry difficult.
Okay.
If you look back at October 21, when we were much ahead of time and we were almost at this 19,000 mark on the Nifty, FPIs I think sold something of $30 billion magnitude over the next 12 to 18 months. And now to put the last 10 billion, which has come in over the last 3 or 4 months, you're finding what's happening to the market. It's accelerating very rapidly.
Okay.
So
Manish,
that's really the land.
I get, I'm sorry I'm stopping you because I've also got to play to the gallery. And this is the bazaar audience. They'll kill me if I don't ask you about how do you participate in this? I mean, do you, for instance, solar? There is no solar company, though we are going whole hog in solar. How do you play it? Do you buy ACs? How do you, play there's so many jobs coming to India?
So let's step back once. That number one, I think as a country, we are underinvested in equities. Because if you look at your asset allocation and we, save, say, $750 billion a year, while we are very excited with $2 billion a month inflow into SIPs, and it's maybe 20 billion, 24 billion a year, it's 24 on a base of 750. So it's 3-4% of incremental saving is coming into equity markets from Indian investors. So I think as a young India, where we are 27, 28 average age, the profile of equity in everyone's asset allocation has to be higher. You may pick your own companies. You should continue SIPs. No one can time the market. It is a high market. It's not by any means a cheap market where there's easy money to be made. But if you continuously keep investing into this market, which indeed a lot of young Indians are doing, I'd encourage you to get your asset allocation right, continue the systematic investment plan. Then we have to worry about, do I do it myself or do I, look at sectors? By and large, the Indian fund managers are among the best in the world. I think if you look at records of people who run their funds for the last 15, 20 years, you'll find the compounding that they've done has been incredible. So there's no compelling reason for you to go out and say, let me jump in and, make the money myself. If you like mid cap, you like small cap, by all means, you can buy those funds as well. However, if you do have a special edge, and like you said, if you're talking about solar, as just an example, the most obvious thing is not to go and buy the solar companies, but the people who benefit from that solar. Now, if you think of India, our Achilles heel has always been our lack of energy independence, and we were dependent on oil prices from abroad. But now with the changes afoot, where India is becoming a leader in solar and we're getting our power costs down, we have still not, gotten rid of all our coal, and we're very, very competitive over there as well. A lot of the large materials companies in petrochemicals or steel or cement can use their own hydrogen, which they are creating to, in fact, lower their power cost. It may not yet be green. It may be gray, it may be blue, or whatever route they're doing. But when you take that along with solar electrolysis and you have the battery technology coming in, we will be at green, hydrogen earlier than people expect. So with this energy transition going on, it's making the country a lot more competitive. And as the currency gets stronger and the interest rates actually remain low, it makes the manufacturing sector a lot more competitive to become a larger exporter. So when you're thinking solar, the actually spin-off and the benefit may actually come to manufacturing. It's not necessarily going into solar directly.
Got that. So manufacturing. Now, the most important part will be what you're now looking at. IT companies are on the wane, and it's banking and finance, which has garnered a lot of investments. How would you play this? is the past the prime in ITs? Do you still go whole hog in banks even at this stage?
So, I'm not writing off IT, and we'll talk about it in a minute. But since you asked about financials, again, like I said, just sit back and think. If we save $750 billion a year, and we are still not even putting half of it into financial assets because it's still going into real estate and gold directly, as we financialize the economy and with what's happening with GST and everyone coming into the formal economy, even now with what's happening with OCEN, even the roadside vendor, when he's starting to get credit, the payments being tracked with what you're doing with UPI or with all your use of Paytm and other stuff. So all the flows are now being tracked, and therefore the economy is getting a lot more formalized. Formalization means it's a lot more financialized. And if that 750 billion of saving, which is also now compounding at the same nominal rate of GDP at 11-12%, the inflow into financial assets is very large. Within that, the share of the better run banks, it could be largely private, but also some of the leading public sector banks, their share of that trade becomes larger. And within that, the amount of products and assets which they can now, array in front of consumers is again mind-boggling. So you've gone from the typical housing loan to the consumer durable loan to then your unsecured loans. Also what they're doing on the corporate lending side. They also own actually all the insurance companies and the mutual funds. So the whole array of what I call financial sector is available to you. And remember, our largest bank, even after the HDFC and HDFC Bank merger, is going to be what, $160, $170 billion in a $4 trillion economy. It's a very, very tiny bank by global standards. The next straight SBI is going to be less than half of that market cap, which is our largest bank. So there's so much headroom. If you just sit and think, where does this go 10 years from here? You'll be actually boggled with the size of the banking sector in India, which plays both onto the retail consumer side as well as onto the manufacturing and infrastructure side. It's sitting right at the center of that. So this is, to me, the leader of this whole bull market.
Got that. This is throwing up more questions, Manish. How do you play financialization? Do you also buy AMC companies, insurance, stock exchanges? And how do you play this theme of jobs coming to India? Do you buy more consumption, consumer durable, consumer discretionary companies? All those questions to Manish Chokani after a very short break. Back in a jiffy.